$1, 2 million sounds permanent at Citadel until a market downturn wipes out $600,000 in bonus money in 12 months. Most high-earning professionals assume elite hedge fund compensation is stable. It's not. Research from the Securities Industry and Financial Markets Association, SIFMA, and insider compensation data from eSpeed and Glassdoor shows that total hedge fund pay swings 30–70% year-over-year based on fund performance and assets under management. That means your expected $1, 2M could realistically land at $400K, $600K in a bad year. A $600K, $800K swing that cascades into mortgage stress, portfolio liquidation, and lifestyle collapse if you haven't modeled it. By the end of this video, you'll understand the exact bonus volatility cycle at top funds, how to calculate your worst-case household cash flow, the emergency reserve targets that protect you against income swings this severe, and the one compensation metric most professionals completely ignore. Let's start with the wrong belief almost every high earner holds. You think a $1, 2M total compensation package is as reliable as a $1, 2M W-2 salary at Fortune 500 company. Here's the reality. Hedge fund compensation splits into two pieces. Base salary usually $200K, $350K, and variable bonus. The remainder, $800K, $900K plus. The base is stable, the bonus is not. SIFMA data on hedge fund pay cycles shows that in strong markets, bonuses hit 60–80% of total comp. In weak markets, they collapse by 50–80%, sometimes disappearing entirely. That's not a rumor, it's documented in Securities and Exchange Commission, SEC fund performance filings, and compensation clawback disclosures that hedge funds file with regulators. Let's put hard numbers on it. A senior PM or portfolio manager at Citadel earning $1, 2M, $250K base plus $950K bonus might expect stable income. But in 2022, when markets contracted and fund AUM declined, the same role saw bonuses compressed by 65–70%, landing actual comp at $450K, $500K. That's a $700K swing year over year. An analyst in the same firm saw similar compression. Base stayed flat at $180K, bonus collapsed from $520K to $140K. The math is brutal, but here's the detail most compensation reports miss. Those bonus cuts often happen asterisk after asterisk you've already committed to major financial decisions. You signed a mortgage in January expecting $1, 2M. You locked in private school tuition at $60K annually. You made tax planning decisions. Then in October, fund performance underperformed and your bonus was cut 65%. You can't unstrike those deals. Here's where it gets worse. Most households making $500K plus don't model this volatility into their financial decisions. The LS data on income stability and layoffs in finance shows that professionals in this band typically carry mortgage debt of $2M, 3, 5M, education funding commitments of $100K, $300K annually, and retirement contributions of $100K plus. That's $2, 2M, 3, 9M in annual obligations built on the assumption of consistent $1, 2M income. Now plug in a $600K, $800K bonus miss. Suddenly your gross income drops to $400K, $600K. Your mortgage payment, let's say $18K, $25K monthly on a $3M Bay Area home, doesn't change. Education funding for 2 kids in private school, $50K, $60K per year, doesn't change. Your tax liability on the prior year's $1, 2M federal plus state plus FICA, roughly 45–50% still comes due, even though this year's income is half that. You've also got health insurance at $3K, $5K monthly, and property taxes on $3M plus in assets. You're facing a $600K, $800K shortfall. Your emergency fund, if you have one, covers maybe 3–6 months. You sell securities at a loss. You reduce 401K contributions, triggering employer match clawbacks. You tap margin account. You delay major purchases. If the down market lasts 2 years, which it did in 2022–2023, you're in structural household debt. Here's the one metric professionals miss: fund level AUM volatility. When a hedge fund's assets under management drop 20–30%, which happens when markets fall, compensation pools shrink by 30–50% even if the fund had positive returns. That's the hidden mechanism. It's not just about performance, it's about total assets being managed. Here's the research-backed action. Model your household cash flow against a worst-case bonus scenario. Assume 50% of your expected bonus doesn't materialize. Calculate your annual obligations, mortgage, taxes, education, insurance. The gap is your minimum emergency reserve target. For $500K base earner expecting $1, 2M total comp, that gap is often $400K, $600K. Most high earners carry $100K, $200K in reserves. You see the risk. Second, stress test your mortgage underwriting. If you're financing based on current bonus, you're financing cyclically, not on base salary. Lenders will approve it, but your household's actual sustainable debt is lower, typically 2–5x base salary, not 3–4x total comp. Third, watch SEC filings and fund fact sheets monthly. Bonus compression happens after AUM declines or fund performance drops. You can see it coming 6–12 months before it hits your paycheck. The delta is clear. A professional expecting $1, 2M annually could legitimately net $400K, $600K in a market downturn, creating a $600K, $800K unexpected loss. It forces immediate debt reduction, asset sales, or lifestyle cuts if not modeled conservatively into emergency reserves and mortgage decisions. Your career is the largest asset you own. Don't price it like it's permanent.